welcome to the deep dive.
Yeah.
Today we're diving into The Intelligent Investor by Benjamin Graham.
Oh, yeah.
You shared that YouTube link to the audiobook, and
Mm-hmm.
I gotta say, even before hitting play, I could tell this one's a big deal.
Yeah.
It's not called the Bible of Value Investing for nothing.
It's true. Even though it was written decades ago, Graham's insights are surprisingly relevant today.
Okay, so let's get into it.
Yeah.
One of the first things that struck me was Graham's distinction between investment and speculation. He doesn't mince words, does he?
Not at all. For Graham, a true investment involves thorough analysis,
Right.
focusing on safety and a reasonable return.
Mm-hmm.
Speculation, on the other hand, is more about
Yeah.
trying to time the market or chase hot tips.
Right.
He's really drawing a line in the sand there.
I feel like that line gets blurred a lot these days.
Yeah.
Especially with all these trading apps.
Mm-hmm.
Everyone's calling themselves an investor.
Right.
But are they? Really?
That's a great point. Graham was already warning about this back in the 1960s.
Wow.
He saw how easily people could get caught up in the excitement of the market
Yeah.
and mistake speculation for genuine investing.
Right. And speaking of getting caught up, Graham also talks about the dangers of relying too heavily on past performance.
Mm-hmm.
He uses this term bootstrap operation
Mm-hmm.
to describe the stock market boom of the 50s and 60s.
Yeah.
Prices were soaring, but earnings weren't keeping pace.
What's fascinating there is how Graham connects that to investor psychology.
Oh, okay.
He argues that a lot of that boom was driven by changing attitudes,
What?
not necessarily real growth in the underlying companies.
He even uses the Dow Jones Industrial Average as an example.
Right.
It had this massive run-up from 1950 to 1970.
Yeah.
But Graham suggested it was more about speculation and shifting sentiment
Mm-hmm.
than actual business fundamentals.
Exactly. And that's a really crucial lesson.
Yeah.
Especially today when it's so easy to get swept up in the hype surrounding certain stocks or sectors. Just because something has performed well in the past doesn't guarantee it will continue to do so.
Okay, so that brings us to another common belief. Graham tackles head-on.
Mm-hmm.
The idea that stocks are a surefire hedge against inflation.
This is where Graham really shines as a data-driven investor.
Okay.
He points to a period from 1966 to 1970 when inflation was soaring,
Yeah.
but stock prices and earnings actually declined.
That's counterintuitive.
Yeah.
I think a lot of people just assume that stocks always go up during inflationary periods.
It's a natural assumption. But Graham challenges us to look at the historical evidence.
Okay.
He argues that there's no clear correlation between inflation and stock market performance.
So it's about questioning those assumptions and looking at the data, not just relying on conventional wisdom.
Precisely. And this leads us to one of Graham's most brilliant and enduring concepts, the idea of Mr. Market.
Ah, yes, Mr. Market.
Yeah.
He's the personification of the stock market, right?
Yeah.
This sometimes manic, sometimes depressed character
Exactly.
who's always trying to buy or sell your stocks.
He's full of emotions, swinging from euphoria to despair.
Oh, wow.
And Graham's point is that a wise investor shouldn't let Mr. Market's moods dictate their decisions.
So how do we avoid getting swept up in his drama?
That's where it gets really interesting. Graham suggests we actually use Mr. Market's irrationality to our advantage.
Okay.
Buy when he's fearful, sell when he's greedy. Have you ever felt that pressure to buy or sell based on the market's frenzy?
Oh, yeah.
Even if it didn't align with your own analysis?
Absolutely.
Oh.
Especially when it seems like everyone else is making money hand over fist.
Yeah.
It's hard to resist that FOMO, that fear of missing out.
But Graham is telling us to resist that urge. Remember, you have more control than you think, even amidst Mr. Market's mood swings.
So we've got Mr. Market and his emotional roller coaster.
Yeah.
What I'm curious about is, what does Graham say we can control when it comes to investing?
He outlines several key areas. First, your trading costs. Keep those low. Don't turn your portfolio constantly racking up fees.
Makes sense. It's like paying a toll every time you cross a bridge. Those small fees can add up over time.
Exactly. And second, be mindful of ownership costs like those pesky mutual fund fees.
Oh, yeah.
They can eat away at your returns if you're not careful.
Okay, so watch out for those hidden costs.
Yeah.
What else can we manage?
Third, and this is crucial, manage your expectations.
Mm.
Base them on realistic long-term returns, not fantasies of overnight riches.
So patience is key. No get-rich-quick schemes here.
Exactly. And fourth, be smart about risk. Diversify your holdings, rebalance periodically, and honestly assess your own risk tolerance.
Don't put all your eggs in one basket and know your limits. Solid advice.
Absolutely. And finally, and perhaps most importantly, you can control your own behavior. Don't get swept away by Mr. Market's mood swings. Remember, successful investing is more about temperament than intellect.
So it's not about being the smartest person in the room, but the most disciplined and level-headed.
That's the essence of Graham's message. Can you stay calm and rational when everyone else is losing their minds?
All right, I love that. Now, a lot of people, especially new investors, might think of bonds as kind of boring, right? The safe but low return part of a portfolio. What does Graham say about bonds?
He encourages us to look deeper, especially for those with a lower risk tolerance. High-grade bonds can play a crucial role in a portfolio.
He even suggests that in certain market conditions, bonds might actually be preferable to stocks.
It might seem counterintuitive, especially after a long bull market where stocks have outperformed. But Graham reminds us to be adaptable. Sometimes a defensive approach is the smartest move.
So it's about having different tools for different situations.
Exactly. And he's quite specific about the types of bonds he recommends. He favors high-grade bonds, particularly U.S. savings bonds, which he calls a boon to investors.
Interesting. He seems to really value that combination of safety and a reasonable return.
He also cautions against getting lured in by the higher yields of lower-grade bonds. For the intelligent investor, the added risk often isn't worth it.
Don't get greedy and reach for yield if it means sacrificing safety. Got it. Now, what about this concept of dollar-cost averaging? I've heard that term but never fully understood how it works.
It's a simple but powerful strategy that Graham strongly advocates for. Essentially, you invest a fixed amount of money at regular intervals, regardless of what the market is doing.
So instead of trying to time the market, you just consistently invest, say, every month or every paycheck.
Exactly. And the beauty is that it takes the emotion out of investing. When the market is down, you buy more shares at a lower price. When it's up, you buy fewer shares at a higher price. Over time, it smooths out your average cost per share.
It's almost like a built-in safety net preventing you from making big emotional decisions at the worst possible times.
Precisely. And Graham goes even further, suggesting dollar-cost averaging can be especially effective for larger sums of money, like an inheritance or a retirement payout.
So instead of trying to find the perfect investment all at once, you gradually deploy that money over time, reducing the risk of investing it all at a market peak. That's pretty clever.
It's a patient and disciplined approach, which aligns perfectly with Graham's overall philosophy. He really stresses that investing shouldn't be about gambling or trying to outsmart the market.
So does he give specific advice for different types of investors? So someone just starting out versus someone closer to retirement?
Absolutely. He dedicates a whole section to discussing different portfolio strategies based on individual circumstances and goals. He even walks through 3 detailed examples.
Oh, I'd love to hear about those. What kind of examples does he give?
For first, he considers a widow who needs to live off her investments. For her, he recommends a balanced approach with a significant portion in high-grade bonds for stability and income.
That makes sense. Her priority is preserving capital and generating reliable income, not necessarily shooting for high-growth stocks.
Exactly. Then he contrasts that with a successful doctor in mid-career who has a higher risk tolerance and more time to ride out market fluctuations.
So for him, Graham suggests a more aggressive approach with a larger allocation to stocks, but still with an emphasis on quality companies.
Right. It's not about reckless speculation, even for the more aggressive investor. And finally, he talks about a young man just starting out in the wealth accumulation phase.
For that scenario, I'm guessing he emphasizes building a solid foundation and prioritizing saving and consistent investing.
Exactly. And he stresses patience and discipline, recognizing it takes time to build wealth. He even encourages the young man to treat his investments as a quasi-business, taking an active interest in learning and growing his knowledge over time.
I love that. It's not just about blindly handing over your money, but taking ownership of your financial future.
Oh.
Now, I'm sure a lot of listeners, myself included, feel intimidated by the idea of picking individual stocks. It can feel overwhelming. Does Graham offer any guidance for those who want to invest in stocks but don't want to become financial analysts?
He understands that not everyone has the time or the expertise to become a, full-blown stock picker.
Right.
That's why he dedicates a whole chapter to alternative approaches,
Okay.
including the use of mutual funds and closed-end funds.
So for those who prefer a more hands-off approach, there are still ways to participate in the stock market without having to analyze every single company.
Exactly. But even when choosing funds, Graham applies his core principles.
Okay.
He emphasizes the importance of low costs,
Right.
a solid track record, and a management team that aligns with his investment philosophy.
So it's not about just picking the hottest fund of the moment, but doing your due diligence and making sure it aligns with your long-term goals.
Right. He cautions against chasing performance, reminding us that past returns don't guarantee future success.
It's like that saying, past performance is not indicative of future results. They put that on every financial disclaimer for a reason. So we've covered a lot of ground, but
Cool.
is there any final piece of wisdom from Graham that you think is particularly relevant for our listener today?
I think the most important takeaway from The Intelligent Investor is the emphasis on developing the right mindset.
Okay.
Graham reminds us that successful investing is not just about numbers or technical analysis. It's about cultivating the right temperament, the ability to stay rational and disciplined even when the market is volatile.
So it's about being emotionally intelligent with our money, not just financially savvy.
Precisely. And that's a message that resonates deeply, regardless of your level of investing experience.
All right, well, I think that's a great note to end on. The Intelligent Investor is packed with wisdom and timeless insights.
Absolutely.
And I encourage our listener to revisit it often as their investment journey unfolds.
It's a true classic for a reason.
Well, thanks for joining us on the Deep Dive. We'll see you next time for another deep dive into a topic that matters to you.